Hello everyone, myself Deepak Gupta, and today we will be discussing the topic fundamental analysis for investment. So, as a investor, we all want to make the investments which we call sound. And when we use the word sound investments, it means they are able to satisfy your desired returns. Now, this word desired is personalized because some people are ready to take high risk and that is why they want to generate more returns, and there can be vice versa where people are risk averse, so they don't want to take high risk and therefore they are satisfied with the lesser returns. So we are not going into that nitty-gritty of calculating risk and the return because that is somehow discussed in earlier session on the topic risk and return. But what our point of view is that when we talk of this return, they can either be fixed income securities, that is where the security assures you of a fixed income in the form of interest. So such fixed income securities are primarily bonds or the debentures. And there are variable income securities where you are ready to take more risk because you expect the returns to be on a higher side. So these variable income securities from normally formally known as equity. So they are a heaven for those investors who are risk takers and they are ready to take high risk because they expect returns which are higher. And these returns, commonly known as holding period returns, will be generated first in the form of the dividend that is received and also an appreciation in price. That is, the future market price is more than the current market price. And then they will receive, when they receive the dividend, then they try to anticipate how much dividend will be received for the years to come. That is the dividend at the end of 1 year, 2 year, and so on. But all these investments will be worth if the price at which you are entering into such investment option, that is the current market price, is appropriate. So we cannot say the word is least but is appropriate because what the current market price, or we can say what the price will be in future after 1 year, it has to be higher. So if you have already bought a security at a higher price, then how can the price at the end of n years can be higher? So every person who is trying to enter into any security, any equity option is basically looking to estimate the fair value of such security. That is the fair value of the security, or we can say that is the appropriate current market price, which will satisfy your capital gains needs through the increase in the market price and also the dividend yields. So we anticipate the future dividends, we anticipate the future growth in the market price, and based on those, we try to calculate the genuine, the fair value of the security. And if the current market price is more or less equal to such fair value, then we enter into such securities. So this fundamental analysis this fundamental analysis is all about the estimation of the fair value of the security. And this estimation is based on an EIC approach or EIC analysis. And this EIC are three distinct words where E denotes economy, I denotes industry, and C denotes company. You analyze the economy, so we can say that economy is the overall domestic territory within the parameters of which your industry is working. For example, if we say India, the Indian economy will support various sectors, which can be metal sector, chemical sector, IT sector, financial sector, NBFC sector, metal sector. So they denotes the industry. And in an industry, there are various companies which are working. So if I say IT company, then IT industry. So Indian is the economy, IT is the industry, and in industry we can have HCL Tech, Tech Mahindra, Infosys, TCS, and there are loads of the companies, and that company is working in the overall industry in the economy. So the value of the equity of a particular company will be affected obviously by the company's parameters, also by the industry parameters, and also by the economy parameters. So we have to do economy analysis, we have to do industry analysis, and we have to do company analysis. And once we are done with that, then we will be able to anticipate the fair value. The word is fair value, which is also known as EVA, economic value of a security. So our focus in this session will be on company analysis, which is a long exercise, but we will try to cover some part of this company analysis in this session. And just a moment, there is a call in between. Yeah. So we will focus on the concept of fundamental analysis through companies angle. So when we enter into this arena of company analysis, then we focus primarily on four factors. Obviously, only if the company is profitable or the profit is growing at a good pace, then the company looks interesting or attractive for investment. So we have to do the profitability analysis, and how we do that, that we will discuss in this session. So our focus in this session will primarily be on the profitability analysis, which is a part of company analysis, which is a part of the EIC analysis, which is a part of the fundamental analysis for investment. So it's a kind of cycle that you have to follow. Then we can have the liquidity analysis, because profitability is different from the liquidity. What you earn is profit, but what you have in cash is your liquidity. Liquidity is always short term presence of the fund. Then we can ask the long term strength. This is the short term liquidity, and this is obviously the profits or the loss statement. In addition, we also measure the efficiency level, because if the efficiency is good, then the profitability will be obviously on a growth path, and there will not be any liquidity in the solvency position. So we say the word efficiency or the activity analysis. So this is measured through the turnover criterion. Turnover is not the sales criterion, it is the speed or efficiency of performing a function. So we have to analyze a company on all different parameters, and today we will focus primarily on the profitability analysis, that because we will have only this much time to support in this session, and the future analysis will be taken up when we will have another sessions on the similar topic in the time to come. So firstly, you have to calculate the EBIT. The EBIT denotes the earning before interest and tax, or the profit before interest and tax of the company. So the business obviously is there to make a sales, and when you make a sales there are costs, and these costs can either be in proportion to the sales, that is, more is the sales, more is the cost, known as the variable cost, or there can be some costs which are not in proportion to the sales, that is, whether the sales is more or less, or even if there no sale is there, such costs will be incurred, known as the fixed cost. So when you deduct variable cost from sales, then you arrive at the figure of contribution. And when you deduct fixed cost from such contribution, then you arrive at the figure of EBIT, also commonly known as the operating profit of the company. So high EBIT should result in high financial wealth for the shareholder. Then this EBIT is used to pay the fixed interest costs, because these interest costs are a huge burden, though they are low on cost, but they are a kind of leverage position for the business, and therefore this cost of debt interest is to be paid. So when we deduct these fixed liabilities of expenditure from the EBIT, then we arrive at the figure of earning before tax, or the profit before tax, which is subjected to taxation. So this PBT or EBT becomes the second criterion, because that in a way is the revenue that will go in the hands of the shareholders, whether they are equity shareholders or whether they are preference shareholders. So that is important. But this EBIT will be subjected to a fixed liability of tax. In the case of company, we use the word corporate tax, and in the case of individuals, we just use the word income tax. And once we pay that tax, we have this figure of profit after tax. So high PBT will result in high tax but also high PAT. And this again is important from the point of view of the equity and the preference, because the difference between the two is a fixed liability which is illegal and cannot be compromised. So once we arrive at this figure of PAT, then there are two things to consider. That either this PAT will be used to first pay the preference dividend, and then whatever whatever remains is what you call the earnings for equity. That is, if we denote it by the form E, then this is what you call the earnings, which will be going into the hands of the equity shareholders. The fourth criterion comes into mind, the earnings, which shall be equal to profit after tax minus preference dividend. And therefore, if we divide these earnings by the total equity shareholders funds, or we divide this earnings by the net worth, and this net worth belongs only to the equity shareholders, then we have this concept of return on equity, that is ROE. So the owners which have started the company, they want to maximize this ROE, and higher is the ROE, higher should be the fair value of the equity that is under consideration for investment. Now, this is a percentage or the proportionate method of calculating the returns for the equity. There is an absolute method also to measure the returns on the equity, and for that, we need the number of equity shares. So, the total equity, if divided by the face value of share, gives the amount of number of equity shares. And if we denote it by an E, so if we divide this E by the number of equity shares, then we arrive at the figure of EPS, that is earning per share. So this is a basic assumption of all financial management decisions, that objective of every successful business has been always not the profit maximization, that is EVIT, but the wealth maximization, that is the wealth is measured by an increase in the market price of the share, and we believe that higher EPS will cause, so this increase in EPS shall cause the high market price, and that will cause the wealth of the shareholders to increase. So we believe that ROE, if it is higher, and EPS if it is higher, then they will cause the increase in the price of the share, or we can say that higher ROE expectations or the higher EPS expectations will have a positive impact on the fair value of the equity under consideration. Now, these earnings will either be declared as dividend, or they will be kept in the business in the form of retained earnings. So if we denote this dividend declared by D, so out of the earnings, the amount received by the shareholders is what you call D, dividend declared, and we divide that by the number of shares, then it will denote the dividend per share. That is how much dividend has been received out of the total earnings of the company by the shareholder, and that denotes the dividend per share. So there is always a say that high EPS will cause high dividend per share, and high dividend per share will also cause the fair value of the share to increase, thereby increasing the wealth of the investors. And therefore, this dividend payout out of the earnings is measured and named as dividend payout ratio. And as per the Gordon's model, this is a common say that high DP ratio shall increase the market price of the share. That is, high DP ratio, as per the Gordon's model, will cause high fair value for the equity under consideration. So, some people will relate the price just with the equity, and they will ignore the dividend distributed, thereby saying that such dividend distribution has no impact on the value of the share. But others, like Gordon and the Mr. Warden, will just relate the price of the share, that is the economic value of, fair value of the equity under consideration, with not just the equity earning per share, but also with the dividend distributed. And therefore, there is no dispute regarding the relationship of EPS with the price, but there can be contrasting view whether the dividend is related or is affecting the price of the share or not. So if we move further, we always relate the price of the share with the earning of the share. And we presume that high EPS will always cause the high price of the share, and this price may or may not be directly proportional to the dividend, because some say it will and some say it will not. Therefore, there is always a ratio of price to the earning. So we take a ratio of the market price with the earning per share, that is P upon E, known as the price earning ratio. And this price earning ratio is an important tool for investment decision. We always take investment decisions based on such price earning ratio. And therefore, in the end, we relate this earnings and the dividend and the market price. So if we reverse this, that is, we make EPS upon MPS, or if we relate dividend to the MPS, so this will be actually 1 upon price earning ratio, and we use the word earnings yield. And here we use the word dividend yield. So all these parameters are used to assess the profitability of the business, which helps in the overall EIC analysis to arrive at the fair value of a security under consideration. We will carry on with this fundamental analysis concept in the sessions to come. Till then, goodbye.